He invoiced $186,000 last year. His bank account has $12,000 in it. His accountant tells him his taxable net profit is $97,000 and he owes $22,400 in taxes. None of these four numbers agree with each other, and he doesn't understand why. The $186,000 is gross revenue. The $97,000 is what's left after deductible expenses. The $12,000 is what's left after expenses, taxes paid, personal draws, and business reinvestment. And the $22,400 is what he owes on the $97,000. Four different numbers, four different purposes. A profit and loss statement is the document that connects all of them. A profit and loss statement, also called an income statement, has three sections. Revenue, the total of everything your business billed or earned during the period. Cost of goods, sold, COGS, for businesses that sell products, the direct costs of producing what you sold. Gross profit, revenue minus COGS. Operating expenses, all the deductible costs of running your business that aren't directly tied to production. Net profit, gross profit, minus operating expenses. For most service-based freelancers, there is no inventory or COGS, so revenue equals gross profit, and net profit is revenue minus operating expenses. That net profit number is what goes on your Schedule C. Revenue is recognized when it's earned, not necessarily when cash arrives under accrual accounting. Under cash basis accounting, which most freelancers use, revenue is recognized when cash is received. If you invoice $15,000 in December and the client pays in January, under cash basis, that's January revenue. Under accrual, it's December revenue. For most self-employed people under $25 million in annual gross receipts, cash basis accounting is allowed and simpler. The choice matters. Cash basis smooths out end-of-year timing, while accrual matches revenue to the period it was earned, which can create year-end tax planning opportunities. Operating expenses on a freelancer's P&L map directly to Schedule C categories. Advertising and marketing. Contract labor, payments to subcontractors, office expenses, rent or lease including home office allocation, travel expenses, transportation, lodging, meals, professional development, legal and professional fees, insurance, software and subscriptions, vehicle expenses, mileage or actual cost method. Each of these is a deduction line on Schedule C that reduces your net profit and therefore your self-employment tax. An expense that isn't recorded in your P&L is a deduction that doesn't exist on your tax return. The P&L is the tax return before the CPI formats it. Net profit versus cash flow is the most persistently misunderstood distinction for self-employed people. Net profit is what remains after all deductible business expenses. It is a tax concept. Cash flow is what moves through your bank account, including tax payments, personal draws, loan repayments, and capital expenditures that may not be immediately expensed. A business can show $80,000 in net profit while the owner's bank account shows $28,000 because $30,000 went to estimated tax payments, $15,000 was a capital equipment purchase depreciated over years rather than expensed immediately, and $7,000 was a loan principal repayment that isn't a deductible expense. Gross margin analysis, dividing gross profit by revenue, tells you what percentage of revenue survives after direct costs. For a service business with no COGS, gross margin is 100%. For a product-based freelancer, a photographer selling prints, a consultant reselling software licenses, The COGS component reduces gross margin. Tracking gross margin over time reveals whether your pricing is keeping pace with your direct costs. A gross margin that is declining year over year without a corresponding reduction in operating expenses will eventually compress your net profit to zero, and the P&L will show it a year before your bank account confirms it. Run a P&L monthly, not annually. Monthly P&L review takes 15 minutes in most accounting software and shows you 3 things that matter: whether your revenue is on track with your annual goal, whether any expense category is running high relative to prior months or your budget, and what your estimated quarterly tax liability is based on current profitability. A freelancer who reviews monthly P&Ls will never be surprised by a tax bill. They see the profit accumulating, set aside the estimated tax accordingly, and adjust expenses proactively rather than reactively in April. Year-end tax planning requires a November P&L. By November, you have 10 months of actual data and can project the year accurately. If your projected net profit is higher than you want it to be, you have time to make retirement contributions, accelerate deductible expenses into the current year, or purchase equipment under Section 179 before December 31. If your profit is lower than expected, you may choose to defer revenue to January under cash basis by delaying invoicing late December work until the first week of January. These decisions require a current P&L. They cannot be made in April with last year's numbers. The Qualified Business Income Deduction, QBI, under IRC Section 99A, is calculated on net qualified business income. You cannot optimize this deduction without knowing your net profit. QBI allows eligible self-employed people to deduct up to 20% of net business income, subject to income thresholds and limitations. For a freelancer with $120,000 of net profit in an eligible trade or business, the QBI deduction can be as much as $24,000, reducing taxable income by a meaningful amount. This deduction is calculated on your Schedule C net profit and phased out above certain income levels. Your P&L is the starting point for every QBI calculation. Your bank balance is not your profit. Your revenue is not your income. And your tax bill is based on a number in between, your net profit, that exists only if you build or maintain the P&L that produces it. Monthly review, November projection, and year-end decision-making on retirement contributions, equipment purchases, and revenue timing all require a current P&L. Build it. Use it. The bookkeeping minimum to make this possible is covered in the Bookkeeping Minimum for Freelancers video, which explains exactly what records you need and how long to keep them. A profit and loss statement is only as honest as the records behind it. Build those records right and the P&L builds itself. If this was useful, bookkeeping for non-accountants, the minimum you need to do every month goes further. It is on this channel.